Hey there, my name is Doug Waldman. I'm the HomeSelect Savant at Geneva Financial, and today we're going to walk through the HomeSelect product. I believe personally, I've been doing this for a very long time, and I believe that this is one of the most powerful mortgages that I have personally ever seen for the appropriate borrowers. It's not for everybody, but for those who qualify, I'm not sure why you wouldn't get into this product versus a traditional 30-year mortgage. So let's walk right through it. The product was originally devised by CMG Mortgage in 2005, so it's been around a long time. We have a lot of data on it. Some interesting facts: there has never been a default on this loan, ever. Powerful. The average client pays off in 7 to 12 years. Powerful. The savings for those who, again, it doesn't work for everybody, but for those who does, can be up to millions of dollars. I have clients that have estimated millions of dollars in savings coming their way. Powerful. So let's walk right through. It's an all-in-one loan. It's, it combines things you do anyways and take for granted. You have a checking account. You'd never think twice about it. You have a mortgage. Never think twice about it. This marries those two financial tools into one. And the effect is significant interest expense savings, again, for those who qualify and those who have more money than month. If you're living hand to mouth, this is probably not the product for you. We'll get into that a little bit later. But this is a 30-year first position lien, or a HELOC. You've heard the word HELOC, which is a home equity line of credit. So this is a open-ended line of credit, not a closed line like your mortgage. Mortgages, the 30-year amortizing mortgage was developed in the 30s, the 1930s. So we're coming up on nearly, 90 to 100-year-old, tool. And it was designed to help people coming out of the Great Depression buy houses because they didn't have cash, right? They were cash poor. They got creamed in the market and whatnot. We needed to figure out a way to get the economy moving and people to get into homes. So they stretched it out for 30 years. But it was designed by bankers. And what that means is if you look at the graph below, you'll see that the darker blue is interest payment. And you'll see that the lighter blue is principal payment. And so for the first 13 years or so, you're paying predominantly interest, which is profit for the banks. Now they're entitled to profit, but when it's all front loaded, that's problematic if you're trying to build wealth and you're trying to build equity. If you're trying to pay this down, it makes it really difficult when all the payments you're making for the first decade are pretty much profits for the bank and you haven't even touched your principal. And they know that the average consumer stays in a loan for 5 to 7 years. And then we refinance and the balance barely ever moves, right? That's problematic. And so this is the solution. In fact, for the first 15 years, you have to get to year 15 before you're even paying an equal amount of principal and interest. 15 years. Our clients are paid off in 15 years with the HomeSelect product. So what we're going to do is we're going to look at a scenario, 7 1/4 rate, which is probably about market right now, 8 1/4 home price, so $825,000 home price, $680 finance. So it's an 80% loan. 30-year amortizing mortgage. That client is going to pay almost $1 million in interest expense. $1 million. That is crazy. The total expense on that property is $1.6 million on a $680,000 loan. $1 million. What would happen if we could keep most of that in your bank account? Let's dig in. Now, traditional loans, there's some good, there's some benefits. They're not all bad, right? It creates a stable monthly payment. You know what your payment is every month. First-time home buyers, people who have low cash flow, like they're just eking by. They have just about enough money to cover the month, right? Passive income earners where, they're not really earning money and it's just kind of floating in. And of course, people who don't have established savings habits yet. People who haven't really shown the ability to handle their finances, then a traditional mortgage is probably appropriate. But there's a lot of negatives. They're slow. They take decades to pay off. for no real reason except for you're paying a lot of the interest to the bank up front. They're inefficient, and again, like we said, it's front loaded for the profits for the bank, the interest. They're rigid. You can't take money out. Like if you've paid down $100,000 on your $680,000 loan, and you're like, I'd really like that money again. They said, great, refinance or add a second, right? It's not a really flexible tool. They're expensive because the average one pays, costs you $50 to $80 per $100 borrowed. So there's a lot of reasons not to use that if you can find a different product. Let me provide more data here. So the HomeSelect product it's devised to put downward pressure on your balance. You can pull money out though whenever you want. So it's a two-way street, which is really unique compared to most mortgages. As we said, most mortgages are very rigid, and this is a little bit more like a line of credit, or even like, you think of a credit card. If you have a balance on a credit card and you pay it off, you've got all that available credit to draw on again. So this is a two-way street, and money flows in and out based on your needs. There's no balloon payments. There's no prepayment penalties. It provides a 30-year period that you can pull money out of your house. And what it does is it starts for the first 10 years at full line amount, and then it starts reducing by 1/240th a month. So at the end of 30 years, you're down to zero ability to draw, but by then you've paid it off decades ago, most likely. In fact, the only time people really seem to refinance these loans is when their $1 million house is now worth 1.5 and they want to go back to 80% to 1.2 million instead of 800,000 and get more access to more equity to a bigger line. And so that's the only time we really see people refinancing this product. It allows up to a $3 million loan amount on owner occupied. It's purchases, you can do refinances. It's pretty interesting because you can actually do a refinance now on, let's say, your $680,000 balance, but set up the line limit higher that you can then get access to whenever you need. So it gives you a buffer zone, a safety net, if you will. Really, really flexible loan product. Owner-occupied, non-owner-occupied, investment properties, even multifamily properties. You're allowed to have one in each category. Again, this is not for everyone. You may not qualify for this product. This is for people who are pretty glued together. I'm not sure if that's you or not, so you'd have to make that determination. 700 minimum FICO score, 90% maximum loan to value, 75% on investment properties, 43 debt to income ratio. So if you take all of your monthly expenses and divide it by your gross income, that gives us a ratio. You need to be, again, this is for conservative people who are savvy with their money and spend less than what they make. If you're one of these people that gets a check and goes, ooh, something shiny to spend my money on, not for you. This is for people that actually have reserves, have savings. You need to have some reserves, but they're very flexible in the reserves. It can be stock, 401k, stock holdings, IRA accounts, gold certificates. So very, very flexible. They just want to they want to make sure that they're not lending to people who are going to get jammed up if they have a hiccup in their lives. So again, this is for more conservative type borrowers. You can do a 5-year fixed rate, a 3-year fixed rate, and right now the clients are really looking at the 1 month adjustable rate mortgage because rates are starting to drop. I have a client that's closing today, and his rate's already dropped over half a point since we started the application process. He's ecstatic, right? He doesn't have to refinance. We know intellectually that rates are eventually going to come down, at least for the next several years, back to pre-pandemic levels. Why not just let this thing slowly work its way down? But one of the phenomenal things you're going to learn is that this thing is pretty impervious to interest rate. The three real factors in borrowing money are the amount of money borrowed, length of time borrowed, and interest rate. So we've been conditioned to think interest rate, think interest rate. If you're borrowing for much less time, like if your house is going to be paid off in 8 or 10 years, you'll realize that interest rate really isn't that big of a deal. Somebody who's financing a house for 30 years at 6% is going to pay a lot more interest than somebody who's financing a house for only 10 years at 10%. Does that make sense? Hope it does. If not, reach out to me and we can walk through it. Rates are very competitive with traditional mortgages. This is based off the CMT, which is the Constant Maturity Treasury Index. And basically what that does is it compiles all the data for sales of 2, 3, 5, 10-year treasury bills on the open marketplace, aggregates it, and then averages it each month, but it's for a 1-year average. So the average moves, but they're looking back for an entire year. It's a very stable market. It's used for a lot of adjustable rate loans as the index, and that's why we utilize it as well. So the checking side of this, so when you get this loan, you're going to get the mortgage itself, the line of credit, and you're going to get a checking account. It's an FDIC insured checking account, just like you're getting at your bank. It has all the functionality and then some of what your bank has. You're going to have 24 access to an ATM. You can write checks. You can wire money. You can bank online. You can bank off your phone like we're now used to. It's going to have full count security, FDIC insured, customer service available. And it's just, again, what this does is it moves money through sweep technology back and forth between the two vehicles, the line of credit and your checking account. Every night at midnight, let's say you've made a $10,000 deposit. The money moves from the checking side to the line side, pushes downward on the line balance. Every night at midnight, it calculates your interest expense based on the balance. So $10,000 lower means you're paying no interest on $10,000. And considering that when you make that $10,000 deposit at your bank, they're paying you bupkis. They're paying you nothing, right? So this flips everything on its head. You pay principal first, then interest. In your normal mortgage, you pay the interest, then you pay principal. So this is a game changer if you want to get financially ahead. So let's look at this, because money is spent periodically, but we're depositing it and then aggregating different amounts that we need for different things. Weekly, you're paying food, entertainment, dining out, fuel. If you're married to my wonderful wife, Amazon. Monthly, you're looking at home utilities, cell phone bills, cable, Wi-Fi, your mortgage payment, your car payment, HOA dues, subscriptions, right? Monthly subscriptions for newspapers or whatever, right? Those are monthly. But you're paying that, so let's say it's a monthly bill. You pay it on the 30th, let's say, but you got your money set aside for that on the 1st, the 2nd, the 5th, the 10th, whatever. And then it sits unused for 2 weeks, 3 weeks. Quarterly, you pay your insurance quarterly, maybe medical expenses, holiday expenses, maybe you're putting money aside for holidays. Semi-annually, your property taxes are paid every 6 months. Travel expenses, you're setting money aside for your big Christmas blowout vacation you do every year to Tahiti. That money just sits in your account until you use it. Why not move it over to the mortgage, push downward? When you need the money for the vacation, you simply write a check like you normally would. But in the meantime, for that year, the $10,000 or $20,000 you set aside for that great vacation is earning for you, because it's earning or sheltering interest expense from you having to pay for it. So it's sheltering you from interest expense. Extraordinarily powerful, right? Extraordinary. Income taxes. Self-employed people have to pay taxes to Uncle Sam, right? We all have to pay taxes to Uncle Sam if we're making real money. But rather than letting Uncle Sam hold it, why not keep it in your account, push downward pressure on your mortgage? Again, I'm not a tax professional, so talk to your accountant about that and make sure that whatever penalties or things you're doing, if you're claiming zero, for example, on your W-2, on your taxable income, be cautious of that. So talk to your professional. But self-employed people that are not making their quarterly, and even if you're making a quarterly payment, hold that money in your mortgage, push downward on it, and then when you start the check, the balance comes up a little bit. But for 90 days, you've sheltered that amount of money from being charged interest. Are you starting to get this? So basically, we calculate interest every night at midnight after we've moved the money over to your mortgage first. So if you owe $100,000, you get a $10,000 deposit, your balance goes to 90. We calculate the interest on the 90. And then 21 days later, you get billed for the interest for the 30 days prior, for the month prior. So you'll look at the slide, you can see that in April, you'll pay on the 21st, you'll pay the interest for the month before, and then April's aggregated interest expense is paid on May 21st. But if you keep doing that on a regular basis, you're sheltering a truckload of money, again, for qualified people. This will not work for everybody. People that have more money than month. If you're saving money pretty regularly, this is for you. So let's look at a scenario. $195,000 net income. So maybe this is a husband, wife, or maybe this is one individual keeping 195 grand, moving into their checking account after maybe paying payroll expenses or paying their taxes with their employer, maybe paying their health insurance, maybe even putting the money into the 401k already. Let's say you got 195 grand getting deposited, divided by 12 months or a quarter or whatever it is. It works any way you slice it. Let's look at your annual expenses. In this scenario, we're assuming the person is spending 75% of the money going into the account. And again, this is already after they've already paid their employment tax, they've already paid their potentially their contribution for their health insurance and for the 401ks or IRAs, whatever. So we're going to assume they have 25% left, roughly $48,000, almost $49,000 left over. It's on a $825,000 house, a $680,000 loan, or if that's what's borrowed, primary residence. Their normal payment would be $4,638 on principal and interest. On this, there is no normal payment because every deposit you make is pushing downward pressure on your mortgage. The only real expense you have is the interest, which is aggregated and then taken out of the account on the 21st day of the next month. Okay, so very, very different way to think about it. But, and even look at the interest rate. So we're saying that we have a variable rate of 8.8 today versus a 7.25, right? So intellectually you'd think like, oh, the 7.25 is going to perform better. Not even close. Because this loan will pay off in 9.6 years, under a decade, versus your 30-year mortgage. And look at the interest expense. In the HomeSelect loan, you have $350,000 in interest expense. In a 30-year amortizing loan on a 680 balance at 7.25, you're going to pay $1 million extra in income expense. Do I have your attention? I bet I do. Let's keep going. This thing is paid off in 115 payments versus 360. And you're going to save $661,000 in interest expense. Is your mind blowing? Right? Crazy. What we see are people that come back and build equity in their houses so quickly that they end up buying investment properties and second homes. And because they have the line, they don't even have to worry about down payment. They just stroke a check right out of their line for the down payment. As long as they qualify for the next house, away you go. And we even have loan programs for investors where we don't care about your income, provided you have a good down payment and that the house pays for itself. So if you're an investor, this is an extraordinarily wonderful tool to start leveraging into more houses. Very, very exciting stuff. And this is interesting. So you look at what is being paid to principal monthly based on our scenario. In this particular scenario, we're paying down $5,900 a month in principal versus $1,800 in a 30-year loan. So we're paying off 10% per year versus 3%. And the percentage of interest charged against the 680 loan is 48% versus 145%. I don't know about you, but saving 600 grand sounds like a great deal. And here's the interesting part, right? Remember I pointed out that our rate was 8.8? And for this assumption, we're just assuming it stays that way. It won't. It's going to drop. The historical rate is only in the 6s. But for ease of operation and without conflating this even further, making this even more confusing, we kept it static at the 8.8, which I pointed out on the other slide where it was 7.25 on the 30-year fixed, 8.820 on our loan, but look at the effective APR. Obviously, if there's no points or fees on the 7.25, your APR is 7.25. Our effective APR is 2.82. And for us to break even on this, for this not to work, interest rates would have to be up to 13.77, almost 14%. Crazy, right? You're able to get a credit limit up to 90% of the value of your property. If you go over 80%, it's going to have mortgage insurance. It's a one-time upfront fee. It's not, horrific considering you're talking pretty large numbers here. And again, like I pointed out, we're assuming that we're keeping the interest rate at 8.82 when intellectually we know for the next couple of years it's going to be dropping. Can't guarantee it. Don't have a crystal ball. Don't know what the Fed's going to do. Obviously don't know the future, but all things being equal, we know there's really no reason for rates to be above pre-pandemic rates, which were in the 4s, 5s, and 6s. That's where we expect to be. We'll see if that pans out. So again, your balance is here. You make your deposits for the month. Boom, balance drops. You start spending money throughout the month. It climbs a little bit. Boom, you make your next deposit. And historically, by doing that, you shelter a truckload of interest if you have more money than month. If you have money piling up in your checking account slowly and surely. So if you've been able to save over the last 10 years, 20, 30, 40 grand or much, much more, this is probably a product you should be reaching out to me and let's discuss this. You can also go to the www.gohomeselect.com and find the simulator and play with it yourself and see what the benefits are. If you have any questions, again, feel free to reach out. I am always available to my clients. But again, we do this. Banking activity drives saving. The more money you're putting into your account, the more money you save and shelter from getting charged interest expense on your mortgage. This is how it traditionally looks, right? So the flexibility, the credit facility of your home, the blue is the principal balance. It starts dropping. All of a sudden, kid goes to college. Boom, you write a check. Balance comes up a little bit. You start paying off it, a couple of years later, 10 years later, whatever, and boom, you're down to zero. Now all of a sudden, you want to buy an investment property. You just write a check. Balance comes up. You keep making your deposits just like you would anyways in your checking account, and rates start coming down. Ooh, honey, let's take that dream vacation around the world we wanted to do. That big cruise or whatever. Boom, balance goes up a little bit, pay it off. A couple years later, we had a medical emergency and the insurance company didn't cover everything. Write a check, pay it off. You have 30 years, and again, most people, the only reason they're refinancing is to get a bigger line or to set the clock over. People that are heading into retirement, think about it. If you're in your 50s or 60s and you're not retired yet, and you can qualify for this, you get this loan. If you're in your 60s, this will carry you into your 90s with money you can borrow. You can write a check against your house. One of the biggest things we've seen is seniors not being able to stay in their homes and being forced into nursing homes because they can't afford to age in place because they don't have the funds to bring in a caretaker. Right? If you're in your 50s and 60s like me, I've seen that with my parents and my grandparents. This allows you to age in place and use your house as a tool, a financial instrument. And again, you can set yourself up where right before you retire, even if your house has a low balance, you might have set yourself up where you only have a $300,000 loan left. Do that, but if your house is worth $1 million, you can get an $800,000 line, slowly work to pay off the $300,000, but you have a $500,000 holy shit fund in the event that you have a catastrophic emergency. Financial planners that have literally walked through this immediately start going, oh my God, you got to talk to my friend Bob, or you got to talk to, he's got $1 million house he needs. In fact, that's how I came up with that scenario. A financial planner that wanted my business said, fine, as long as I can talk to you about this product. Before we even got on the call, he started doing research. All he wanted to do on the call was talk about this product because he had clients that, hey, I've got a guy that's going to move from New Jersey to Colorado and buy a $2.5 million house, $1 million down. He's still going to have big income. What would this thing look like? And he's going to sell another house in 3 years and pay it off. I had a CPA call me up and we walked through the program. She says, Doug, I've got a client that has a $1.8 million jumbo loan in Southern California. The guy had a 8% some odd rate because he had just bought the house right in the middle of the rate bump, right? We ran the analysis. The guy's going to save $1.8 million in interest. That is like buy a yacht type of savings, right? That is huge. That has set up a philanthropic organization That is create legacy for your children type of money, right? Why give that away if you don't need to? If you qualify for this, again, game changer. So again, you can go to the simulator. It's a pretty simple thing. It just asks you about what are you comparing? What's the value of the house? How much is the loan? Are you going to compare a 30-year mortgage to this? Great. What state are you in? Right now, the only state we don't offer this in is Texas. It's going to ask you about how much money you're depositing every week, month, quarterly, whatever it is, annually. You'll put that in. The next stage is it just wants to know how much money you have saved at the end of the month. In other words, on the average month, how much money are you not spending? $2,000, $3,000, $5,000, $10,000, right? I have clients that are, prospective clients that are going to pay off in 5 years and save $500,000. www.gohomeselect.com. Again, my name is Doug Waldman. I am the HomeSelect Savant at Geneva Financial. I'm happy to help and answer any questions you may have. Walk this through with your spouse, your financial planner, your CPA. Again, it doesn't work for everybody. Not everyone qualifies. But if you are one of the people that do qualify, you owe it to yourself, you owe it to your family to take a serious look at this product. I haven't seen anything like it. That's why I'm so excited about it. It creates wealth. It creates equity for appropriate borrowers. Again, reach out. Doug Waldman, thanks for watching.